At first glance, Shell selling its entire European onshore renewables business looks like a retreat from the energy transition. But the more important change for shareholders is narrower. Shell is reducing direct ownership of renewable assets, while concentrating on the parts of electricity it believes it can operate and monetize better. TotalEnergies is buying around 500 megawatts of operating or developing solar and wind capacity, plus a 3.5 gigawatt pipeline across Italy, Spain, and the UK. Completion is expected by the end of 2026, subject to regulatory approval, and Shell has not disclosed the price. This is therefore not yet a reported earnings event. It is a capital allocation signal. The timing matters. Just days earlier, Shell reported adjusted second quarter earnings of $9.8 billion, operating cash flow of $21.4 billion, and another $3 billion buyback. Recent coverage framed the company as a stronger LNG and cash return story, using higher commodity prices, trading gains, and projects such as the ARC Resources acquisition to support the idea that Shell was building a higher return portfolio. The renewable sale qualifies that reading. Shell says it is high-grading its power portfolio, recycling capital, and prioritizing differentiated capabilities, including asset-backed power trading and customer-focused energy solutions. In practical terms, Shell is giving up ownership of a large development pipeline and a smaller base of operating assets. TotalEnergies will own those projects. Shell will remain involved in buying and selling onshore renewable power, but the bodies available here do not quantify how that change will affect Shell's revenue, margins, or cash flow. That distinction is crucial. Owning generation can provide exposure to the long-term value of the assets, but it also requires capital, construction, and operating risk. Trading and customer solutions may require less direct ownership, but they depend more heavily on market conditions, contracts, and Shell's ability to use its broader energy platform. The strategic direction is visible. The financial payoff is not yet measurable. There is also a credible alternative interpretation. This is not Shell abandoning every low-carbon activity. It retains interests in offshore wind, Holland Hydrogen 1, and carbon capture and storage, and the company says it will continue trading onshore solar and wind power. Meanwhile, TotalEnergies is buying the Shell assets because they complement its gas-fired generation and integrated electricity strategy. Its separate €1.8 billion deal with KKR shows that developed renewable assets can still attract infrastructure capital and long-term investor conviction.
So this is not evidence that renewable power has become worthless. It is evidence that Shell no longer wants direct ownership of every part of that market. The move appears more structural than a one-day shock because it follows the direction signal that Shell's 2025 Capital Markets Day and sits alongside other portfolio disposals. But the magnitude remains unresolved. The sale price is unknown, and there is no disclosed estimate of the effect on future earnings. For a holder, the lesson is not to treat Shell's latest buyback as proof that every part of its growth strategy is working. The buyback reflects current cash generation, much of it supported by volatile oil, gas, and trading conditions. The renewables transaction says future growth may be increasingly concentrated in LNG, selected energy assets, trading, and customer relationships, rather than in owning a broad European renewable pipeline. For someone watching the shares, the key question is whether Shell can turn that narrower model into dependable returns. The next scheduled results on 29 October should offer an early checkpoint, although the available evidence does not provide a precise target to monitor. Investors will need to see whether capital spending, the renewables and energy solutions business, and shareholder distributions begin to reflect a material change in the portfolio. For now, the strongest conclusion is that Shell is not simply leaving the energy transition. It is choosing to stand further away from the physical assets and closer to the markets and customers around them. Whether that becomes a more profitable energy model or merely a smaller renewable footprint is still the part shareholders cannot yet see.